There's panic on Wall Street. I'm your host, Steve Van Metre, and thanks for joining me today. And it's worse than we thought as FedEx signals that a global recession is imminent. Let's over to CNBC where we picked today's story up with the headline: the FedEx CEO says he expects the economy to enter a worldwide recession. I think so, but these numbers, they don't portend very well, according to Raj, the CEO of FedEx, in response to Kramer's question of whether the economy is going into a worldwide recession. The CEO's pessimism came after FedEx missed estimates on revenue and earnings in its first quarter. The company also withdrew its full-year guidance. I'm very disappointed in the results we just announced here, and the headline really isn't the macro situation that we're facing. On an interview, he said during Mad Money. Now, it's important to understand that when a company pulls their forward guidance, that is not a sign that things are getting better. Because when you hear from companies or entrepreneurs, when they're discussing their business or their quarterly earnings, they're always like to project that, hey, things are going to get better. Maybe they're going to get a little bit worse, but don't worry, we're turning things around. But when a company goes out and says, look, we're not even going to bother telling you about the next coming year, it's because it's far worse than we think, and their stock is reacting accordingly. The chief executive, who assumed the position early this year, said that weakening global shipment volumes drove FedEx's disappointing results. While the company anticipated demand to increase after factories shuttered in China due to COVID opened back up, it actually fell, he said. So that's interesting. You would expect that as these factories in China open back up, that the shipments out of China to the U.S. and other parts of the world would pick up, and it'd be great business for FedEx. But the fact that they're not tells us something that we've been concerned about for months, that the global economy is indeed slowing down. Week over week, that came down. The chief executive also said that the loss in volume is wide-reaching and that the company has seen weekly declines since around its investor day in June, meaning the economic slowdown started in June. We're seeing that volume declined in every segment around the world, and so we've just started our second quarter. The weekly numbers are not looking good, and we just assumed at this point that the economic conditions are not really good. We are a reflection of everybody else's business, especially the high-value economy in the world. And he's got a great point, and something that I've been talking about is that we're going to see earnings and profits fall in the third and fourth quarter, and now what FedEx is saying, hey, yeah, that's probably going to happen, because if you think about what FedEx is a great proxy of, is telling us where business is happening, because when you buy something, how does it get you? Well, it gets shipped, and probably through one of a few carriers, it goes through FedEx. So if we see FedEx's volumes dropping, what does that tell us about retail sales? What does it tell us about new orders? What does it tell about the manufacturing sector? It's telling us it's all going to start slowing down if it hasn't already. And while this performance is disappointing, we are aggressively accelerating cost reduction efforts and evaluating additional measures to enhance productivity, reduce variable costs, and implement structural cost reduction initiatives. These efforts are aligned with the strategy we outlined in June, and I remain confident in achieving our fiscal year 2025 financial targets. And let me translate what all this is going to mean. Layoffs. You got it. And here you can see, as part of these cost-cutting initiatives, FedEx will close 90 office locations, close 5 corporate office facilities, defer hiring efforts, reduce flights, and cancel projects, all in a sign that indeed more layoffs are coming. But what does this mean for the broad stock market? Well, let's take a look. Because FedEx is a great leader of where the market's going. We have FedEx here in the green and red, and notably you see this big gap down in price. That is this morning, and in blue, purple, I've overlaid the S&P 500, and what it's suggesting is that it is going to follow FedEx lower. And there's one thing that shouldn't gap down with the market, and that's your portfolio. I'll put a link up here to Portfolio Shield and description below, because let's see where this goes. We had some data yesterday that's now telling us that the government data is lagging, where FedEx is telling us the economy is headed. U.S. retail sales unexpectedly rise after a drop in the prior month. This headline from Bloomberg, as the value of overall purchases rose 0.3% in August, above estimates, as July retail sales were revised to a 0.4% decline. The value of overall retail purchases increased 0.3% last month after a downwardly revised 0.4% drop in July. Excluding gasoline, retail sales were up 0.8%, showing that there's still demand from consumers. Although these figures, aren't adjusted for inflation. 8 of the 13 retail categories grew last month, according to the report, including a surge in sales at auto dealers. Purchases at furniture stores, health and personal care stores, and non-store retailers declined. The value of sales at gas stations slumped again, reflecting cheaper fuel prices. So what you're seeing here is that people are struggling with inflation, and one way you can deal with that is you can actually use less fuel. You travel less, you consume less, you start planning your trips out, and you keep your travel time to an absolute minimum, and that's not good for the economy. What's validating is indeed that people can't afford higher prices, and they're having to cut back where they can. While households are breathing a sigh of relief from lower prices at the pump, widespread inflation is limiting Americans' ability to spend on other things. Whether that be necessities like food or more discretionary purchases like back-to-school items, still the report suggests consumer spending is far from collapsing, but that is coming. And here you can see when we look at advanced retail sales in blue against the Wilshire 5000 price index or the total U.S. stock market, both on a year-over-year rate of change. And what we can see is when the stock market comes crumbling down, well, retail sales are soon to follow. And you can see in every instance heading into a recession, you see a big collapse in the stock market, followed by a plummet in retail sales. And simply because the stock market is the U.S. economy. When people have less wealth and feel less wealthy, what do? You got it. They spend less. And some other evidence to support that retail sales are indeed coming down. We have here the current new orders, the diffusion index for the Philly Fed. Now, this is very noisy, and of course, that is what we typically see out of these regional Fed surveys. But notably, we see that it is falling here and heading in a downward trajectory. And we can note that when it does have these big declines, like we've seen here, that it usually follows with a drop in retail sales. And it would make sense because you think about it, is if you're not selling your inventory, so if retail sales are slowing at your store, well, what are you not going to do? You're not going to go out and put out a bunch of new orders because you don't need the inventory. So you drop your new orders, and that means, of course, we see retail sales fall. Now, if retail sales were really driving hard, well, what we should see is new orders rising with it. So new orders telling us the demand in retail is falling. And all that translates to the manufacturing sector. It too will head lower as the U.S. manufacturing output increases for a second straight month as factory production rose 0.1% in August after a 0.6 advance. But hang tight, as you'll see, that's headed lower. The 0.1% increase in manufacturing output last month followed an auto-fueled 0.6% July increase, including mining and utilities. Total industrial production fell 0.2% in August. So you might be saying, that's not much. And you're right, it isn't. While domestic demand is generally holding up, manufacturers face a number of headwinds, including a shift in consumer behavior towards services and far away from goods. That change in preferences caught some retailers flat-footed, leading to an inventory overhang and canceled orders that are further weighing on production. And here you can see that, of course, we talk about new order growth. Again, we go back to the Philly Fed, that's in red, new orders diffusion index. Now we'll overlay industrial production. And what we should see and what we do see is that as new orders decline with a lag, production falls. And it makes perfect sense that why that happens is because if new orders are indeed falling, of course, the factory is still producing the orders it's got, but as those new orders decline, production falls. And so what we should see on this chart is just exactly what you should expect. A decline in new orders should lead to an outright collapse in production. And the stock market is also a good proxy of this. We can see, of course, demand here as the stock market heads lower, industrial production follows it with a lag. We see that the market heading lower, telling us that industrial production isn't long before it too falls off a cliff. And all that comes back to import prices and inflation. And what we should start to see is both come down as we see import prices slid in August, offering some inflation relief. And prices of imported goods dropped 1% in August from July, marking the first consecutive monthly retreat since the pandemic began in spring 2020. Excluding petroleum, prices dipped 0.2% from July, according to the Labor Department. So again, when you talk about all of this, what you're seeing is evidence of a slowing economy. FedEx telling us, hey, things are getting bad. That should translate to retail sales, manufacturing production, and what we see is a stock market and new orders They're great indicators. And when we see import prices fall, that's not a sign of demand, because what we should see in the global economy, as long as demand remains strong, is import prices should be going higher and higher and higher. And of course, what we're seeing is they're starting to head lower, a sign again that the global economy is indeed slowing. Lower August prices for food, feeds, and beverages, non-fuel industrial supplies, materials, and automotive vehicles more than offset the higher consumer goods price. And here you can see in this chart, in blue, we have import prices on a year-over-year rate of change against the consumer price index. And what we should see, and what we do expect, is that import prices lead to consumer price index. And sure enough, what you see is as the blue line heads lower, you see the consumer price index follows it, and you see it does it generally with a lead. And here you can see import prices are heading down, telling us that indeed consumer prices will follow lower at a time when we know the Fed next week is likely to hike rates. Now, let's head over to our chief strategist, Jeff Snyder, and see what he has to say. He follows up with the retail sales data and notes that accounting for inflation, even at a much reduced pace since March, is exactly the same problem experienced throughout the rest of the world. Euro dollars, he's referring to the dollar shortage, are no one's friend. Just as the countries around the world are quickly running out of dollars, Americans too are inching closer to the same limit, only in real economy as much as monetarily. It's neither inflation nor sustainable unless massively inverted curves, referring to the Treasury yield curves, that are actually suggesting that inflation or deflation is coming. Of course, if you want to know more about what Jeff Snyder says, be sure to click the link for Markets Insider Pro. Countdown clock is on for a limited time. And let's follow up with one last chart from Jeff, who notes that real retail sales, or inflation adjusted retail sales, remain flat and even perhaps slightly declining against rising inflation. You see here in retail sales, again, the headline number not adjusted for inflation. So now you understand why is there panic on Wall Street? Because FedEx is saying all the people that are really bullish about stocks are about to be on the wrong side of the fence. And I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.